That didn't make much of a difference. Off target. Target reports earnings. FOMC minutes are out, and President Donald Trump wants Federal Reserve Governor Lisa Cook out as well. We'll discuss and take your questions and maybe ask you a couple today on Open Interest. Hello, everybody. I'm Mike Coe. Welcome to Open Mic. Fed officials highlighted the risk to inflation as outweighing concerns over the labor market at their meeting last month, as tariffs fueled a growing divide within the central bank's rate-setting committee. Jerome Powell said after that meeting that the inflationary impact from tariffs could be temporary. It's a comment that we've made here on this channel as well, that could be more of a step change or discontinuous function, I guess. But the central bank does need to guard against a more persistent effect. Emerging markets were also getting hit. So I suspect that folks will be scrutinizing the comments coming out of Jackson Hole, which is upcoming even more closely as a result of all of this. And as I hinted at just a second ago, Target earnings came out. We actually talked about Target. I think that was the example we were giving on Monday when we talked about call spread risk reversals, calendar call spread and put spread risk reversals, and strangle swaps. And as it happened, Monday morning quarterback, I think we can pull this up. Let me see. I'm going to get this on. So maybe we can get this on the screen. Even if we can't, I can read it on my other one. But Monday morning quarterback asked a question about. Oh, it was. I'm being corrected. I thought it was Monday morning quarterback. It was. Now it's up on the screen. There we are. AAMTB said, regarding strangle swaps, or double calendar diagonal spreads for a post-earnings play, I've noticed that back-month implied volatility is so unknown that if it crushes a few percent, the whole trade falls apart. I've monitored the implied volatility for 1+ year out, and they still drop 5% after earnings. Half the time I'll get lucky, and the back doesn't crush, but it seems like you have no idea how that back month is going to act, or am I wrong? Okay, so we do have some sense, but actually one of the trades that we talked about on Monday was a strangle swap. And on my screen here, I don't know if we're going to be able to pull up an image. This is an image of how this trade is doing now. But I don't know if we can find an easy way to get an image of the trade that was discussed on Monday. If not, you can go back and scrub through it, or I can just tell you what it was. So on Monday, we talked about the fact that, and we were using Target as an example because I had previously used Target as an example. And don't forget that when I set these calendar trades up, and I think this was the point that the whole conversation began with, the idea is that you sell premium, and then when that has lost 80% or so of its value, that you then roll and sell more premium against it, and so on. Rinse, repeat, rinse, and repeat. The example of a trade that I provided on Monday, ahead of Target earnings, was the following. Long the November 90-120 strangle, that was a cost of about 685 was the price of that strangle, and short a September 26th 92-120. So it was a straight call calendar on the upside, and it was a diagonal put calendar on the downside. All right. So that trade which we built into the, I actually just put this in, but we put it into the portfolio. We should probably do this every time we come up with an example trade. I think I'm probably going to do this. Just add it to a portfolio, which we're going to call, this is actually under the options action worth thing, but I'm just going to name it the open mic portfolio. If we come up with a trade, whether it's your idea or just something that comes up, we'll throw it in here and then we'll monitor how it does, and then we'll evaluate it after the fact. That's probably a good way to think about it. So at this point, at least according to this, as of the closing prices. Now, this is interesting because by my math, that should have cost $375, and this is marked at $335. This is showing a $110 profit. That doesn't seem right. There must be something wrong in there. I'm going to go to more details. What do we got here? There's something wrong. There we are. That is what's wrong. Okay, this should actually be, yeah, so let's do this. Because actually I was noticing, kind of to AMTB's point, that if we take a look here, so this is the volatility for target, the implied volatility. Now, remember what we want to have happen in this trade. The ideal case in a strangle swap would be for the stock to run to the strike, right? Because that means that you're maximizing the value of the longer dated option, but the nearer dated one as of expiration. So there's still a little bit of time to go. We'll see. That would hint at down to, say, $92 or so on target. It didn't quite get there. Target actually, it fell, and it fell a decent bit, but it didn't fall quite enough. Yeah, 98.70 was the closing price today. And you probably would have found yourself at the sweet spot had the stock fallen to $92, right? Which is down a good bit more. That's a pretty big move. But like I said, there's still a little bit of time on this one. So let's just I'm going to pull this back up. And what we're going to look at now is what are the delta of these remaining options. I'm actually going to bring this up separately because one side of this trade, for example, these SEP 120 calls, remember we want to cover options if they've lost 80% of their value. These have not quite, have they? Let's see, what do we got here? So this is 43 cents, and those were $1.50. Well, we're getting there, right? So those have lost 71.5% or so of their value, the SEP 120. So you maybe not covering those today, but my guess is you would cover the September 120s before the end of this week. And then you would look to sell more premium against it. So what premium would one look to sell against it? And the point that AMTB is making is that in some of these cases, you've got vol out long swinging around quite a bit. And this is a really good example. I'm kind of glad we went through this one. Because in Target's case, last month, you actually would have been a winner on the calendar spread immediately. And then you would have made more money over the course of time by continuing to roll the short strangle component. This time, overnight, you actually are down money because of that vol crush, hitting the outdated areas a little bit harder. So we can see that here, right? So this is what happened to this vol, right? So the options that we have that are expiring on Friday went from 72 and closed. I actually almost would have expected this to come in a little bit more. It's still quite elevated. This probably should have come in a little bit more, and it probably will, right, over the course of tomorrow and the day after. But the interesting bit is that these November options fell from 41-ish down to 36-ish. So 5% or so. So actually, I don't know whether AMTB was looking at this exact example, but your 5% number is spot on in this case. So how do you estimate that? Well, what we're looking at right here is going to be, I'm going to actually push it out to 6 months. I'm going to look at like the Jan options. And then you have to kind of interpolate or extrapolate, depending on how you're modeling it, backwards. But in terms of the vol crush, I'm going to look at January as an example simply because it's easier for me without building a spreadsheet to illustrate how you go about doing that. But let's just take a look at how 6-month options did over time. And the way you can do that is you would just take a look at, and I don't care how long you look at it, but let's look at it for 2 years, partially because there's a lot of other kind of funky stuff going on in there. I'm going to get rid of the realized vol because all we're thinking about right now is the change in options premium. So this is the change in 1 month. Really easy to see the increase in implied volatility for the event and then the vol crush that takes place after. These are all, of course, earnings, these humps. And you can see the move immediately afterwards. But now we want to take a look at the longer dated options and see the effect there so that we can estimate it. And this is that. And you can see that in this case, the options premiums don't fall anywhere near as much in percentage terms, but these options have a lot more Vega, right? So it's not like it's totally inconsequential. As we look at what happened to the longer dated options in Target, I think the important thing to recognize is that this whole area right here, so this area right here, this is above average volatility to begin with. So there was a lot of sort of additional concern or uncertainty about Target's price going into this event than there have been, at least in the areas going before the first quarter of this year. And so just get rid of this for a second and we can take a look and see that mean 6-month volatility was about 32. So if I just draw a line at 32, let's call it 32 and a half. It's right about here. So that's the mean volatility. You can see that in the past, it's been rare that it's been this much higher. Now, there were good reasons. We saw that it was here before this earnings and here. So you could actually have reasonably said, okay, well, I think it's going to come back to this level. That's what it did the last time. The time before, it came in much more and over here. And then we had some periods where the volatility was a little bit lower. But from my perspective, I think, you know, this trade could still turn out just fine. If that's the one you did, just roll out when you collect 80% of the premium, rinse and repeat, as we described. Now, we did describe another trade, and I think this is going to be kind of interesting too. We described a long at-the-money call. I think it was the 110s. So let's just go through this exercise. So I'm going to build out a new trade now. So it was long the November 110s. Again, I'm going by memory, and then short that same strangle, if memory serves. So then we're going to add a call and a put. These are both short. This was the SEP 26s. And those were the, pretty sure those were the one, also illustrated with the 120s and the 92s. If somebody knows different, by all means say something. So I think that was that trade. Now we're just going to go in to trade that thing. And I'm going to let me see here. What these prices would have been. Well, I'm just going to add, let's see this. Okay, so all right. Yeah, you know what I'm going to do? Hang on. I'm going to let the crack production staff work on correcting the prices for the first trade, and I'm actually just going to use my my Bloomberg here to yank up those prices as of. So I can just do this. So I can construct those trades. So it was the target, US, 08, 22, 2025. Oh, no, I'm sorry. These were the... I'm going to put these in. This is not all that interesting, I know, for you guys to see me doing this, but it is a way for me to pull stuff up. I can just, because I know the syntax for the Bloomberg tickers, so I can, and November regular way expiration is the 21st. So I can actually just manually construct these. And I believe this was for the diagonal call spread risk reversal. I'm pretty sure these were the strikes. Today is the 20th, so that was the 18th. So we'll just put that date in. Let's see if that works. Okay, it does. So that was $3 and that was $3.93 for that one. And that's a long delta trade, right? So that would have been a proxy instead of say doing a buy right. That would have been the way to get long, mildly long, instead of say selling that upside call. Now, had you done the buy right, you would have made about $1.10 on the short call, and you'd have lost $6.70 on the long stock. So that would be a $5.10 loss. This trade was $3.93 to initiate, and is $1.60, we'll call it. Yeah, it's about $1.60. So a similar type of a trade structure, taking less risk because you're short the 92 puts and trying to benefit from the vol crush on both the upside and the downside. And, you would have taken a mildly bullish bet, but lost considerably less than doing the buy right. But just to sum this whole thing up before we move on, because I think this was a really valuable conversation. Question 1 was, how do you estimate what the vol crush will be? And we hope to be offering out some techniques and tools to do that on the fly. But the simple way to do that is just get a hold of a time series. You're not interested in historical vol. Take a look at the tenor that you're interested in. And, you're going to be dealing with a relatively small number of events. 8, maybe 12. And don't forget that you don't want to go back too far, because you could be bumping into a very different regime than the one you find yourself in. You're going to, if more data is generally better, but you have to make sure that it's data that's still useful. And the example that I like to come back to and have used as an example on this channel many times is the cruise lines, right? You can't compare cruise line volatility in the post-pandemic era to what it was in the immediately pre-pandemic era, because the balance sheets of those companies became much more levered. They took on considerable amounts of debt, so the volatility is just generally going to be higher. In Target's case, if you wanted to look at this, you could, and if you're going to go back a couple of years, and you can break it out into quarters like this, and just take a look at the financials, and you can see we've got, on a debt to equity basis, right now, it's got about $15 billion in net debt relative to $45 billion of market capitalization. And if we go back, let's see, is that still comparable? So we'll go back 8 quarters, because that's what we were just looking at. 4, 6. Yeah, it looks like it's probably pretty consistent. It's about the same, so that's fine. So in the case of Target, going back 2 years is totally fine. If you're looking at something like Carnival Cruise Lines and you're going back and you said, oh, I want to take 10 years worth of data. Well, that doesn't really work so well because there was a period where they had a big ramp in the amount of debt that they had relative to their market cap. So the equity became a lot more levered. I think Royal Caribbean, it was a similar picture. Was it a similar picture? Let's go back. I need to go back further than this. So we'll say, go back to 2019. 2019, about $12 billion worth of debt. And we fast forward to 2021, and they had, about $20 billion worth of debt. So that's a pretty big increase. And it's certainly a huge increase in terms of debt to equity, right? So those are the things you want to pay attention to. So yeah, I hope that helps out a little bit. Let me just quickly pull up over here and see if we have any other questions in the same thing. Well, oh, there's Monday morning quarterback. Okay, yeah, you weren't asking about target strangle swaps. You were talking about getting toasty in Orinda. It's funny. It's pretty. Doesn't normally get too warm over here, but I was not in this room, and they didn't have the air conditioning on in here, and I came in right before we got going, and it's not something I always think about, and I got it going now, but it's if I look a little sweaty, that's the reason. We didn't get the air conditioning going on in here fast enough, and heat does build up in here because it's a bunch of lights, and I have 1, 2, 3, 4 computers, 8 screens, and a bunch of things that I don't know how much heat that monitor throws off, but every little bit is problematic when it starts getting hot. Okay. Given the current, so this is the question I wanted to ask you guys, which is, as we think about the structure of these conversations that we have, how would you kind of like to see this go? Do you want a quick synopsis where I just go over some of the economic highlights like we just talked about the FOMC minutes at the beginning of this? Do you want it broken into some theme, like we'll talk about industrials on Mondays and then consumer names on Wednesdays and then maybe technology names the following Monday, that kind of thing? Any suggestions are welcome, because one of the things I've learned working with the folks at YieldMax is that they poll their investors all the time. And so a lot of the product that they're releasing, that's how they decide what it's going to be, which is a really obvious and sensible thing to do, and I realized I hadn't done it. So I figured I would. If you have some thoughts about what that structure might look like, rather than kind of the loosey-goosey, hey, if you have any questions for me, approach that I have been taking, let me know. And also, by the way, if anybody has any questions about options, one of the other things that has come up as a function of my working with them is that I realize that there's a lot of people that have really big misconceptions, misperceptions, misunderstandings about actively managed ETFs. Well, about ETFs generally, about how distributions are thought of, active managed ETFs and how that works, and options within them. So these things, talking to people, I realized that there are a lot of questions, and even how the NAV is calculated, how the difference between the NAV per share and the share price after hours works. So if you guys have questions about that, let me know, and I'll probably formulate something a little more formal to deal with that if we do. Given the current VIX, would you buy put spreads in SPY, SPX, or triple Qs or IWM, or futures options on those? Okay, so let me deal with the last part of your question first. There are significant benefits in terms of the hours that you can trade on futures options. The futures market is open more hours than the regular listed markets are. And so a real benefit to those is that you have access to additional trading hours, if that's important to you. I would say, though, that SPY, the Qs, NDX, SPX, the Russell options, and IWM, these things have really nice, tight option spreads. There's so many strikes and expirations. There's just a great deal of flexibility. I like NDX and SPX and the Russell. I like the cash settled options because I've seen bad things happen when people end up with the underlying, with a position in the underlying. So if you're short calls and you get called out, rather than just dealing with the difference on that day, on the day of expiration, you're now subject to, potentially, the risk of the delta of the underlying thereafter if you take assignment or you exercise the options or they are exercised automatically without your knowledge. So I think which one makes the most sense. And also, one additional point, some people just think about the markets in one of these instruments. So for example, I have two friends of mine who are always talking to me about the market in terms of SPY. The SPYs did this, the SPYs did that. And it just strikes me as strange because for me, it has always been the S&P or SPOOs, which is how we used to sometimes refer to the S&P futures. So I'm always thinking about the S&P either in percentage terms or if somebody says, oh, the market moved 50 handles. That resonates with me. That's how I just think about it. So there is a value in trading an instrument that is the one you always look at. So if you always look at SPY, then you probably should just trade SPY options. They are also 1256 contracts, by the way, so it's not like there's a huge tax difference. They are American, which is a little bit more problematic, and they settle into the underlying, which I think can be a little bit more problematic, but some people might like that as a feature. So I don't necessarily encourage one over the other. It's really a little bit more about you as an investor, as a trader, and how you think about things. I think about things in S&P terms. That's when I think about the market, I think about levels in the S&P. I think about the futures on the S&P. That's just the way I think about it. And I like instruments that are European because it makes the math easy. And I like them to be cash settled because it's kind of set and forget. If you accidentally leave a position and it runs through, you don't get assignment or exercise surprises. And that's a real benefit. But I think any one of these is fine. So let's talk a little bit about, not having answered, well, or not answered, depending on your perspective, the question about the instrument you use. Now let's talk about whether or not this is a reasonable time to employ a put spread. See where the VIX is right now. It's still less than 16, which is higher for sure than it was. But take a look at this chart. It's not like this is how much more you're paying for options today in implied vol space. And of course, the S&P is a little bit lower. Is that expensive? Not particularly. So let's just say you think about the world in terms of SPY. Okay? So now let's actually look at implied volatility, the price of options, relative to spot, the same way we were for target, except that I'm going to pick an expiration. I'm going to pick, because I happen to think that, for me, I think of the risk, I keep saying this, I think that the market's biggest risk lies between now and the end of September. Post-Labor Day period, we've still got Jackson Hole. We've got the next Fed meeting coming up in September. It's a historically volatile month. It's pre-announcement season. People are trying to digest the impact of tariffs, and this will be the first full quarter to do it. So for a host of reasons, I think that there's a lot of things that could happen. Will they? No. Do I want them to? Certainly not. I don't want a bear market. I don't think anybody should ever wish for one, regardless of what you happen to think about asset prices. But so let's take a look at this and say, okay, well, what about this at the beginning of this week? So let's just take a look at that. Why not? That's where we were at the beginning of the week versus where we are right now. Okay? Our options a little bit more expensive. Oh, by the way, if you can't read this little tiny font, I'm going to have to do something about this legend. The white is today's, okay? And red is where we were on Monday's close. So today's close, Monday's close. Is vol higher? Well, it is a bit. The downside puts are, well, I mean the at the moneys, because this is, there's a smirk. So The low point is not at the money. The at the monies are right here. So is at the money vol higher? Yes. Are these downside puts a little bit higher as well? Also yes. So you're not going to pay a whole lot more today than you would have done on Monday in vol space to put on a put spread. So, by the way, this goes to the question, I think, that you had, which is, do I think it's worth hedging at this point with put spreads? I answered that question last week when I said, I think it makes sense to buy some put spreads going out to the end of September, just because this is the period of this year that so far in my mind I'm most concerned about. You know, all of the other stuff has generally been good, but this is the part that I've been most concerned about. Max Convexity, hello from Austin, Mike. Hello, sir. Great to have you here. By the way, you know, some of the folks that are watching this also host their own, you know, programs and things like that. Have spaces on X. Max Convexity is one of those, and I participated on that just recently. So I encourage you guys to give these people a follow and go and listen on these spaces yourself, or even participate sometimes. So in any case, I hope that helps on the put spread question. FinWest says, aloha, Mike. Thanks for interviewing Domenico last month. Very interesting to learn of his work. We're on the same page. Selling puts on stocks we're okay to own. Hope we hear more from him. As a matter of fact, we are going to hear more from him. He and I are discussing our very next video, and our hope is to actually do these quite regularly, maybe 1 or 2 a week. So for those who don't know, Domenico, that FinWest is referring to, is Domenico Dal Olio. He's a lecturer and adjunct professor in Italy. He's a quantitative researcher, and he's been working with a gentleman named Vlad Furman on a product called Trade AI. Now, I've known Vlad for a number of years, and I'm familiar with his work and thought it was an interesting thing to highlight. In fact, I'm even talking to him about how we can take this data and turn it into, you know, just regular digestible reports so that people can say, okay, if I was going to sell options, they're mostly about option selling. And I encourage people who are interested in trading options that if you think about the best way to add some alpha or some additional income, that it's probably better to start with that. I'm not going to say that debit spreads or buying options to make directional bets doesn't make sense. But on the whole, I think people who are just getting started in options are going to be far better off selling them than buying them. Right after I said buy put spreads for the end of September, which is the other thing I would say, which is that long options, whether it's spreads or outrights, are strategies that are best suited to tactical bets. So that's tactical hedging or catalyst-driven directional bets in an underlying. Those are times when it really makes a lot of sense to do that. MM said feedback. Probably my fault. And then the feedback was gone. If that was my fault, and it usually is. If it's a technical problem, it's probably I hit the wrong button. I left 2 microphones on. I'm leaning on my keyboard. Who knows? Okay. Monday morning quarterback. I usually sell call spreads in Russell to finance SPX put spreads. Thoughts? Interesting. Okay. So IWM, I'm sure most of you guys know this, but I'm going to say it anyway. IWM is the ETF that tracks the Russell 2000. Recently, the Russell 2000, actually not even recently, just in general, the Russell 2000 hasn't really been keeping pace with the S&P. And, you know, there's a couple, our intuition could give us a couple reasons why that would be true, but the important point I would make is that the Russell 2000 is the small cap publicly traded companies, and they tend to exhibit higher volatility and higher implied volatility. So if you are selling call spreads in the Russell to finance purchases of put spreads in S&P, so don't forget, a short call spread and a long put spread are synthetic synthetically equivalent. If they were the same strike and expiration, they would be, kissing cousins or synthetically equivalent to one another. So selling call spreads is just the credit spread way to do it, and buying put spreads, as we think about it, and buying put spreads is the debit spread way to do it. Now, you could buy in the money put spreads, which are really more of a credit trade because as time passes, it's on your side. In other words, if I have an underlying asset that's trading 100 and I own the 120, 110 put spread, that's going to go to $10. It will converge to $10 at expiration, and I will pay something less than $10 for it. So it will behave in much the same way as a short 110, 120 call spread would. When you say you're buying SPX put spreads, I assume that, like most options traders, you're talking about buying out of the money SPX put spreads and financing it by selling out of the money call spreads in IWM. It's an interesting approach. Where does a trade like that tend to go wrong? A trade like that will tend to go wrong. If you suddenly start to see, if the S&P trades sideways and the Russell outperforms, your put spreads in the S&P aren't going to do anything for you, and you'll lose money on the Russell call spreads, right? That would be where that trade sort of goes sideways. But the truth is that equity markets tend to be correlated. Let's take a look at SPY versus IWM, for example. So here we are, long SPY, short IWM. And you can see, let's get a regression in here. Okay. You can see just how much these things tend to track together. R square of almost 80. So this is very little question that these things do tend to track together. So that's an interesting approach. And if you are not in favor of small cap stocks, in particular, that would be interesting. What would be a reason why you would be more averse to small cap stocks relative to large cap stocks? Well, what environment would create that? Well, one would be, for example, rising interest rate environment. Smaller cap companies are not, they are lower quality credit borrowers on average and depend more on that. So they are more vulnerable to it, to rising rates in many cases. That's a broad generalization. Every company is different and it deserves some investigation, and we could talk about that if we wanted to. But I do think that there can be circumstances where you're making sort of a broader assessment about why one group would outperform another. I mean, you can do that on a sector-by-sector basis. You can do it on an industry-by-industry basis, or you can, as you are here, kind of evaluating small caps versus large caps. Large caps, these things don't really depend heavily on the credit markets because the biggest companies are generating free cash flow like mad. NVIDIA, Apple, Alphabet, Meta, these are not companies that are going to the debt markets. They don't need to. The debt markets are really coming to them because they got to figure out what to do with all the free cash flow they're generating, and many times those go into short-term interest-bearing instruments. Okay. MM says, hi, Mike. Is Jackson Hole plus seasonality plus valuations a great opportunity to buy vol through roughly the end of September? So my answer to that is I like the idea of a tactical put spread hedge on a broad market index. And I don't think that you necessarily want to buy vol across the board. And what are some of the reasons for this? Well, one is that implied correlation. So that's the implied correlation is the relationship between index volatility and the volatility of all of the constituent stocks. So if the market starts to really get chopped up, what happens? Volatility rises and implied volatility rises as well. So that's the price of options. Will the price of options on Tesla and NVIDIA, MicroStrategy, and all these things go up? Yes. But will they go up as much as index volatility will? And the answer to that is no. Sort of one way to think about it is that correlation goes to 1, and as correlation goes to 1, then the sum product of the weighted volatilities of all of the constituents of an index would add up to approximately the volatility of the options on the index itself. And that becomes a functional arbitrage. Like, the index cannot be more volatile than the volatility of everything that's in it, by definition. So it should never be the case that it would cost more to buy index options than to buy weighted options on all of the constituent stocks of it. But that does tend to converge in times of market duress. So what that means is that the bang for your buck, if you get a swoon in the markets, is going to tend to be better in index options than it will in some of these other things. Could like I said, could the volatility of NVIDIA rise? Sure. But from what to what? Right? So NVIDIA right now, 26 vol. Well, it did get up to 75. That's pretty good. But what can happen to the VIX? The VIX can go from 15 to 80. I'm not saying that's what's going to happen in September. God help us. I'm not wishing for that. But you're going to get. That's where you're going to get the bang for your buck, the gearing. And imagine this: if you have a portfolio of stocks, and you're kind of laddering short calls against your portfolio of stocks, and you're concerned and want a tactical hedge in the S&P, so you buy the S&P put spread, and that put spread, maybe it pays 5 to 1 to get you downside protection, call it down 10% or so by the end of the month, and you're financing that by selling some upside calls, and because implied correlation is not 1, you're going to collect more money on your short calls than you pay for that put spread. Also, the put spread is limited in the amount of protection, whereas if you sell upside calls, you're basically capping your gains. But you could still put that structure on and have a net positive carry. So you're mildly long deltas, not as long as many deltas as you are right now, because of course you're buying put spreads, selling calls against it, but you're mildly long equities, which we like. You're going to be getting positive carry, which we like, and you would have a hedge on, through the September. And by the way, if what we want to have happen, which is that we don't have a swoon, it's not going to cost you the whole wide world to put this trade on. Will you make less? Yes, but you'll still be positive. If the market goes higher, you'll still win. On the other hand, if you get long vol and just flatten your deltas out, so you're just straight long vol, and we manage to make it past, you're not going to be up a modest amount of money. You will lose, right? You get long premium expecting something to blow up and it doesn't. That's going to be a loser. So that would be the reason I'd be more inclined to use S&P put spreads as a tactical hedge through the end of September and not start modifying your core holdings. Stick with your core holdings, the stocks that you like. Ladder some of those calls because you might get an increase in implied volatility, so you're going to collect a little more. And again, structure it so that you have a little bit of positive carry. One other thing, actually, I think this is worthy of note as well, because I realize that I've said now a couple of things, and if you put those all together, and I don't add what I'm about to, it could end up being a little bit tricky. So let's say, for the sake of argument, that you sold some upside calls, and all of a sudden the market does swoon. You've got the put spread on, so that's great. And you're thinking, oh, look, my P&L is pretty good. What do you do now, right? The short calls have lost 80% of their value. Do you just blanket buy those back and then sell, 16 to 20 delta calls on the upside? So imagine you did that and leave your put spread alone. Well, that isn't such a great outcome, because think about this. If it's a sharp drop with a sharp V bottom, now you've rolled your calls down and the market rebounds, and now you're going to be bumping your head up against your new short strike. And if you didn't monetize your put spread while it was down, now you didn't take the money for that either. So you had insurance, the P&L on your account was stabilized, but you need to monetize that hedge not just the calls. And if you are concerned about the V-shaped bottom, when you roll down to call credit spreads and cover your put spread or roll the put spread down as well. So I'm glad this kind of came up because I've seen this happen. People have bought a put spread and then the market sort of rolls over and they're looking at their account. And as the market goes down, their equities are losing value, but the put spread's gaining value. So they're like, oh, this was great. And then all of a sudden, the put spread goes to call it 70 or 80% of its value, which means most of the money that you could possibly make on it has been made. Now, if the market continues further down, you're not going to get more protection. Or if it rebounds, you'll have just given back the profits that put spread gave you. So you do need to do something. You get a 5-to-1 put spread. All right? What's a 5-to-1 put spread? You know, I'm paying a little less than, pay $2, or that's 4-to-1. If I paid $2 for a $10 put spread, that's 4-to-1. And that thing goes to 8. So it's worth 80% of all of its potential value. Well, you need to do something with that. Right? So just make sure that if we do get a swoon, the thing we don't want, but if this is how you're structured, take the money on your short calls and take the money on your put spreads. And if the new news that's coming out, because presumably we're going to have more information, but if you start getting new information that suggests, wow, this is actually worse than we thought, not just economic data, but I don't know how this would happen, but geopolitically we actually get some conflagration and you start thinking, well, man, it is a correction. It could turn into a bear market. Well, then you can take your put spread and roll down or roll down and out. It will cost you more, but that's going to be better positioned for a V-shaped bottom. So something, and by the way, some of the yield max ETFs that sell options, this is something they're very, very sensitive to. And, talking to the traders and hearing what they have to say, this is something they really care about. So this week has been obviously not great for a lot of the high-flying stocks. They're short a lot of calls. In many cases, they've made 80% of the money on those already. They're already covering that stuff. And because they're concerned about, a sudden snapback, if they're going to sell calls, they're being kind of judicious about that and selling call spreads. And this is the kind of thing that I think is just generally sensible. And monetize your options when you can, because they have, after all, expiration dates. Okay. So, hi Mike. Assuming that argument that SPX may go through some correction in September, how would you hedge a $100,000 portfolio with SPX Euro options? Okay. So this is it's a good question, and what makes this a little bit tricky using SPX options is that, of course, SPX is a bigger contract than SPY. We went over this a little bit, I think, on Monday, but the value of a single SPX combo, long call, short put, is over $600,000 a piece, one contract. So if I'm long one call and short the corresponding put, synthetically I'm long over $600,000 worth of the underlying. Does that mean you can't use SPX to hedge a $100,000 portfolio because the contracts are so big? No, it doesn't mean. Well, you could use minis, but let's just start with, can you do something in SPX that will give you some measure of insurance because you like what I just described, which is that it's cash settled and you want to set it and forget. Well, if you buy one put, you're going to be net short. Let me give you an example. So let's just go right out to September 26th. Weeklies. Oops, I'm not in the right product. Let's try that again. It's like, why don't I see a month ending? There's always a month ending contract. Okay, so now we're in SPX. Try that again. So we're going to go right out to the month end. So September 30th. So if you were going to say buy puts, I remember Goldman Sachs always used to make this recommendation. Maybe they still do, but it was a very common thing for them to tell folks you should buy 30 delta puts. Okay. So if you bought one put in here, so let's just compare this. This one I can't put SPX in, but I'm going to just compare. I'm going to build a SPY option in here, and then we'll look at the SPX option in the Bloomberg. We can sort of toggle back and forth that way. So we've got SPY. I'm just going to use as an example a single put expiring, September 30th. So let's just say you followed the that Goldman Sachs. I had a colleague who was worked in Goldman Sachs in the derivative side, and this was something they used to talk about. You know, buy a 1 month if you want to hedge tactically. Buy a 1 month 30 delta put, gives you nice convexity, not too much time and premium and so on. Okay, so that's going to cost you about $6.70 versus $640 in SPY. So that's going to be $670 for a one lot. Now, if you trade it in SPX, that's going to be a little clunky. You wouldn't do that because that would be the 6250s. And the 6250 puts, those are here, are, you know, about $61.50. We'll round it up. We'll call it $62. $6,200 a contract. 6.2% of the value of your underlying position. But that doesn't mean you can't use them because you can narrow the distance between the strikes, right? So if I bought, say, instead of buying the 6250 puts, I said, okay, I'm going to buy the 62.75, 62.25 put spread, right? So this is 66.5, and the 62.25s are 57. So now I'm going to spend $9, about $900. All right, so less than 1% of my portfolio, to make a bearish bet. Now this particular trade, which is $50 wide, and I'm paying $9, has, let's see here, enter. Let's see, 18. Yeah, so you're getting better than a 4-to-1 payoff. So that is a way that you can use these instruments, you know, essentially. And when you do this, just make sure that you kind of think about, okay, the percentage changes that are going to be required. You know, 62.70. This thing would have a break even at 62.66 on the downside at expiration, cash settled, so you wouldn't even have to do anything. 62.66 versus, I'm going to call it 63.96 just to, again, to keep the math easy. That's 2%. So that would be one way to do it. SPX minis, of course, same thing applies. So just think about the notional size of these, but yes, you could use SPX minis as well. Okay. Eric M. Hi, Mike. For bullish trade on GDX, would you look at selling the OCT 5268 strangle, around 15 deltas on each of those, and buying the NOV 21st 60 call? Well, let's take a look at GDX vol, first of all. Some kind of weird rhyme in there. And actually, I would take a look at the constituent earnings also. This is going to be a little bit important, but we'll get to what I'm talking about there in just a second. Okay, so kill this. So we're just looking at the present, and you're going to ignore that as well. So you want to do a November 52, 60, 68 call spread risk reversal. It's a little bit of a spread. So you're going to own the Novi 60s here, and then you're going to be short the OX here. Well, okay, let's think about this. I'm going to bring back this situation here. Okay. And let me go back a little further. Let's take a look at a couple different volatility. Let's go back a month, and let's go back 3 months. All right. lot to look at here. I realize that. I'm going to lose this spread here because that's not really meaningful in this context. I'm going to ditch. Oh, stick this down here. Why am I showing you all of this? When you engage in a calendar spread, one of the things that you are contending with is how volatility shifts over time. Now, we often talk about something called a vol cone. What's the vol cone? The vol cone is simply the fact that near-term implied volatility, the vol of vol, is higher for options that expire in the near term than it is for options that expire in the very long term. And this should make some intuitive sense. Volatility is kind of a mean reverting process. So 2-year options volatilities aren't going to swing around quite so violently in response to news because there's all kinds of things between now and then. Whereas short-term options can move around quite a lot. You have an upcoming event, they blow up in value. That event, if it's the only one, comes and goes, and it suddenly comes down. Now, where does this play when you have shorter-term calendar spreads like this? Now, we're dealing not with an index, not a normal index anyway, because the gold miner sector index, this is really a much narrower thing than a general broad market index. But it's not quite a single stock either. So things like earnings, you don't have a single earnings, you have several, but they're all in the same industry, so what's true for one is probably true for many. So what you really want to pay attention to if you get into a trade like that is if I'm buying an option here and I'm selling an option here and I see that the surface sort of swings around like this. Is that the right way for me to do it? I'm trying to think about it from your side. But the near-dated options rise much more and fall much more than the longer-dated ones. Where in the arc of travel in that am I? Now, what you'll notice is that right now, the options you'd be buying are cheaper than they have been, but the options you'd be selling are, in fact, much cheaper. So, to me, I would probably, in this environment, just simply put on a call spread risky in November. Everything all just one expiration. Because these OCs are pretty cheap, right? And for all the reasons we just described, if vol pops, those are probably going to pop more. They have a little bit less Vega, but you're going to be short more of them because you're short 2, long 1. So when you put the whole thing together, you're probably short vol, and you're short more of the vol that's going to rise more. I think you see what I'm getting at. I don't know that there's as much of a benefit in this instance. Now, if this was shaped the opposite way, so can I just draw on this, or I don't know if I can just draw here, but maybe you can see my little cursor. If the curve was shaped more like, yes, that works. Aha, there we go. So if it was shaped more like this instead of like that, yeah, now if I had only known that a second ago, then we'd know what the vol cone was. In fact, actually, what I'm going to do is I'm going to clear all of that, and I'm going to get rid of all of this. So here we go. So now, to the point that I was just trying to make, if this is vol when it's lower, and we think it's going to rise, what's the vol surface going to do? It's going to do this. It's going to look like that. Okay? So here's what you bought, and here's what you sold, but you're sold 2x this. Okay? So you're short 2 times as many of these. They have less Vega, but you're short 2 times as many of them. So when this goes up, it's going to go up more than this one will. Okay? So you're just trying to be short premium, and you want long deltas. I would just stick to a single tenor. Okay. All right. So let's move on. FinWest. It would be great to go over the mechanics of the option ETFs. Yeah, I think that's important too. And I think to do that, an important thing would be to have more concrete sort of illustrative slides. Because there's a bunch of things that I've noticed one of the most common misconceptions has to do with return of capital, which is how you characterize a distribution from a fund. When you recognize that a fund may have many things in it, it could have earned interest income, it could have dividends from the underlying stocks, it could have extrinsic premium that's been collected because you were short options, it could have short-term or long-term capital gains or losses. And so when you take a distribution, what do you want that distribution to look like, and if it's characterized as return of capital. So all of these different moving pieces, and the best thing for me to do is to come up with a simple example that uses perhaps one underlying and a bunch of different options and examines it at different periods of time and says, here's the objective, here's the strategy, here's what happens if the stock rises, the parts that win and lose, and then the distributions and how you account for them. So that probably deserves a little bit more attention. Okay, so let's see. Eileen, your whole show is so interesting. Yeah. Anybody who likes to watch me use Excel, boy, there's got to be more interesting things to do than watch me use Excel. And so many people who are really much better at it than I am. But I use Excel in conjunction with the Bloomberg for most of it's like my scratch pad for thinking about stuff. And yes, Alex V, the SPX minis would be fine. Hitan or Hitan Patel. Hey Mike, I am new to options trading. If I want to hedge 200,000 SPY, is it better to use 3 times inverse or regular SPY put? I definitely, myself, would always favor, if you're comfortable with it, using SPY options. Couple of reasons. One of those is that you then know exactly, you can always figure out exactly what your exposure is. And I want to say that levered ETFs, it's not that they don't have benefits. They do have benefits. What's an important benefit of a levered ETF? Well, one of those is that they trade like a stock, which means they trade after hours. Options don't. The counterparty for every options trade is the OCC, and consequently, the market's either open or it's not, and if it's not, you can't trade them. Full stop. Now, if you hold a fund that owns options, the value of, or has embedded optionality, like a levered ETF, or even the yield max ETFs, I mean, these things have options in them, but they continue to trade after hours. So you have essentially ways to get into and out of your positions as a function of that. But if that isn't a big concern of yours, you're mostly just interested in buying a hedge, and you're not concerned about being able to trade something after hours, the reason that the straight options are better is, number one, you know exactly what you have. The costs are quite low, and you can tailor it exactly to what you need or want. So you're new to trading options. You want to use an inverse ETF. Now you're long an ETF and you're short an ETF. I'm not sure that's a great, why don't you just sell your underlying if you're concerned about it? Because now you've basically created an offset. For the optionality, I realize there's an optionality component, but I think that if you buy, say, 1/3 of your SPY position in a 3x inverse SPY ETF, you're not going to get any extra benefit from that you wouldn't get from just, say, buying a downside put. So I would say, unless you need the after hours feature, probably better to just trade the options yourself. And the levered things, they have embedded decay in those. There's a roll cost. So you might look at the price chart of an ETF that trades options and you see that the price chart is static or it goes down over time. That doesn't necessarily mean there's a roll cost, because in many cases you're getting distributions and the total return is what matters. But in the case of the levered ETFs that don't pay distributions, there is a roll cost. So let's take a look real quick, and then I realize we're dragging on a little bit. see how much assets this one has in it. So it's got 5.2 billion. Okay, so you would be, yeah, you could short this, but there's also inverse ETFs. But the question is, over the long run, does the convexity element actually pay for itself? Well, let's take a look here. So you can take this instrument, and we can put in SPY. And so now we're looking at the total returns for these two instruments over the course of time. And you can see that the 3x ETF over time doesn't quite triple the results. And that's because of those embedded costs. Now, that might be okay for you. And it probably, you know, if we look at it instantaneously, so this is where we do the exact thing that we were doing before, remember? So I handled that well. So we're going to say long this and short that. So we are short the 3x levered ETF. Now, if I do a regression, and let's see, then we should see, yeah, so you see this here? We get a slope that is indeed about 1/3. So this is instantaneous. This is looking at the dailies. So overnight, it is almost exactly 3x. But over time, it isn't because of that cost. So I hope that would that's helpful as well. But familiarize yourself with options so that you don't have to use these things if you don't want to. Because that cost does add up over time. Although, look, I mean, the one nice thing about these things is that they can only go to zero. So if you had bought it with that in mind a while back, not with a whole lot of margin, but if you just said, look, I want leverage to the upside, but with defined risk, and I'm willing to pay a cost for that, for the benefit of that leverage, yeah, I mean, I guess the product's fine in that case too. So let me see. Did I miss anything really important? I probably did. I tend to. I always see it at the end. Finwest says, those darn leverage ETFs bit me hard, UVXY. Well, the volatility ones, that's even more tricky. That's a whole nother kettle of fish. Probably deserves a show all its own. All right, so I've taken up more than an hour of your time, and I really appreciate the patience that you guys exhibit by listening to me ramble on this way. But I'm glad you do, and it helps me as much to know what interests everybody as it does just to hear myself speak. So for that, I thank you for watching, and I hope you tune in and watch us again on Monday when we come back for open mic. And we may indeed have office hours. I haven't managed to connect with Mark, but hopefully we'll have office hours on Friday too. Thanks for watching.